keep this up, positive in trading, no matter what happens, because sometimes we actually, even myself now, after so many years trading, I sometimes feel down and frustrated and negative at first, but you have to keep thinking that no, you want to be thinking positive, because a positive mindset will help you in your trading and in your life as well, not only in that. So welcome again to episode 4, and shall we start? Is everybody hearing me fine? All are aboard. So let's start with the PowerPoint presentation. Thank you, Omar. And here we go. So today's episode, Trading Simply, we're going to first look at simple charts and technicals. I told you many times previously that I like to keep things very simple. So simple trading setups as well. We're going to see what trading setups are. A few examples, we won't be able to see them all. And simple entry and exit points, also very important. Exit points. Everybody is always so concentrated on entry points. However, I've noticed that 80% of new traders or even veteran traders don't plan ahead their exit, and then they start scrambling to say, oh, I should have gone out, I should have stayed. Questions like that you should not be questioning yourself once you're in the trade. So that's actually not a simple way of doing things. And these charts, this chart is someone that, is a real life chart, is not just a joke. I added this cartoon, but this is actual, someone's chart, and I'm not sure what they see in it. I had one of my people on my team also had a lot of resistance and support levels, but the way he was doing it is he was putting support resistance levels, but then forgetting to erase them once they don't apply anymore. And so they stayed. And then he was, showing that to clients, and everybody was so confused. So I told him, why don't you erase the old ones? And he said, I keep them just for, later on. But the problem is then your chart looks like this, and you don't want that, because it's more confusing than anything. Okay, so the best technical to use, remember, keep it simple. What I use, and again, try also always to research on your own, use your own indicators, back test them, etc. Because I've seen as well that with my students, some of them were very successful using their own indicators. And I never said, I never say no to anyone. I never say, no, stick to what I teach you. Because again, as I've said so many times in the past, there is no magic formula. And some students ended up making much more money than I did. So I never want to limit anyone's potential and telling them to just use what I do. Because if what I was doing was, the perfect case scenario, I would have, been on the top 10 traders list in the world, maybe. So with all, keep it simple, because I've noticed that a lot of successful traders do keep it simple. So I learned as well along the way from some of the best, and I'd like to transmit this knowledge to you. But again, if you want to test a few things, tweak a few things, go ahead, because you never know. Okay, so I use one extreme conditions indicator. I use the RSI. Some people use the stochastic. They're all, different formulas, different mathematical formulas, but they all end up giving you, if you fix them and tweak them, customize them, they will give you what you need, which is when there's a trend. And remember, all these technicals, most of them only work when there is a trending market and not a sideways market. And so when there is a trending market, the RSI, for example, the relative strength index, will give you an overbought or oversold condition, approximate. Okay, so you will know if it's time to get out maybe of your position, exit your position if you're long, or if you're short, or maybe enter also a position. And then finally volume, because I like to see any unusual volume surge. A surge in volume will indicate usually a strong momentum, accelerated momentum, and that may lead to a breakout, breakdown, or any other trading setup. Okay, so the best time frames that I use are the hourly, the 4 hours, the daily. This information I might have shared with you in the past. However, we'll go through them very quickly again. So the best time frames, of course, it all depends also on the type of trader you are. Some traders only keep positions for 15 to 30 minutes. That's what they're used to. That's what's been working for them. It doesn't for me. I like to keep my positions for sometimes more than a day, sometimes weeks. Okay, so but it's not, again, this is not written in cement, so you can try and do different things by yourself. I think someone asked the questions. That's why. Okay, that's wrong. Okay, sorry about that. So let's go back. So this is the time frames that I use. The hourly, of course, if I want to look at the short-term outlook, and for me, a short term is a few hours. So obviously, I'm going to look at an hourly chart. The 4 hour is if I want to look at the next few blocks of 4 hours, so a couple of days. And the daily is I want the big picture. Okay, so some people don't even look at the daily because they trade smaller time frames, like a 15-minute time frame. And if they're successful, if they're making money, there's nothing wrong with that. Let's jump on to the next slide. Am I still sharing the screen? Yeah. I can't see it. Yeah, I don't see it either. Okay, here we are again. It's fine now, right? But we went to a previous slide, so let's jump through the next one. Okay, the simple moving average. The simple moving average that I always use one near term and one long term. The 200 moving average, I use it for one particular reason, is that I found out, and if you read about it, you're going to see as well, that top fund managers, investment banks, big market makers, and participants use the 200 moving average. So it's a tool that a lot of people use. Obviously, I want to use it as well because I want to see what other participants are looking at, to maybe understand behavior or understand what they might be doing or thinking. Okay, so the 200 moving average, I think everyone should use. Some people just think of it as, I heard an analyst in one of the big firms on Wall Street say, because everybody's talking now about the S&P 500 reaching or even crossing a 200 moving average, and he says that's just a line. I don't know who invented these lines. What does it mean? He doesn't. For him, they don't mean anything, and that's fine, because they might not mean anything, but the fact that so many people use them and rely on them and maybe even put limit orders near them are going to automatically affect the market, right? So even if you don't believe in technical indicators, or that you think they're all random and these are just mathematical formulas, there are actually there are 200 moving averages, just the average of between the open and the close of the last 200 periods. So what? Why is it going to affect the market? Is because so many participants use it or look at it. So it's a self-fulfilling prophecy, right? And so I use the 200 moving average. I also use the 20 moving average or the 50 moving average as a near term. And I always watch if there is a trending market and there is a reversal. I always want to look for a cross between the near term and the long term moving average. Okay. And so, however, don't hesitate to use a different moving average that fits better with the time frame you are using. For example, on this chart, you can see the 20 moving average price is not even touching it, right? It's not even getting close to it. It's fine, you can keep it, but you have to maybe, change it a little bit so that it fits like here. So this is what I did, was I changed from the 20 to the 10 simple moving average, and look at that. We can see that the price is, practically bouncing every time it touches it for many periods. Okay, so obviously this means something. This line's here it crossed a little bit, but that's a false breakout. And since it's a trend up, usually when there is a trend up like this, the bulls tend to fight back very, very hard. So you always yes, you might have went long here and put a stop here, and these things happen. They should be criminal, but unfortunately they're not. These are the most frustrating things when you get out here at the bottom because you think it's going to cross and then it goes back up. Okay, but I usually mix moving averages with another tool, and we talked about that before, is higher highs, higher lows. So I always look also for, this is for example a high, it went lower, did it go low to the previous lows? No. Then it went higher, did it go low to the previous low, which is here? No. Okay, so I would usually put my stop at the previous low, because then the trend up would, in my opinion, be null, and it might be a reversal. So yes, there is a moving average, but combined with another indicator would be extremely smart. I always try to do that, use 2 or even sometimes 3, because when you have these 3 confirmed, it boosts your confidence, because these 3 are telling you exactly the same thing, and that boosts your confidence. Again, here we have a higher high, low but not as low as before, etc., right? So we never actually broke the uptrend, and the moving average was nicely this 10 moving average was nicely supporting our price. Okay, so let's move on to trading setup. What is a trading setup? Okay, obviously it's a configuration of candlesticks in a chart. Does anybody here, does everyone here know what candles are in a chart? You might use bars or other line charts, etc. I like to use candlesticks for a very good reason, but I'd like to also see if you guys use candlesticks or not, or maybe some people don't even know what candlesticks are. Can you please answer? Yes, you can answer on the chat, please. If someone doesn't know what a candlestick is, or wants to have, maybe a small intro on candlesticks, or are we all okay with what they mean and what we're looking for? Okay, that's fine. Everybody seems to be familiar with candlesticks, and so that's what I use. And like I said, the benefits of a trading setup, or what the criteria that you should look for in order to get the benefits of a trading setup are, first of all, 1 or 2 confirmations, like a pattern or an indicator. So first of all, a pattern could be a trend up, the price is trending up, and we have higher high, higher lows, higher high, lower, higher lows, and this is a pattern, maybe combined with a moving average, and that would be 2 confirmation. Okay, some people just use 1, it's fine. I like to use 2. Sometimes I even add, as I said, 3, the overbought, oversold conditions, although not necessarily wait for all 3 to tell me, the same thing, right? So like a pattern or an indicator, like an indicator such as a moving average or any other indicator that you like to use, delivers an expected outcome in a high proportion of trades. So you back test, you look at the past, and you see if this pattern delivers a high outcome on each instrument. It's different. So you can't really use the same, always the same tool, same patterns on all instruments. Sometimes what works on the USD Japanese yen, for example, doesn't work on the Euro USD, right? And so because they both move differently, they both have big participants that are sometimes different, right? So, and always remember that the market makers and the big participants that are assigned for an instrument or a sector are not necessarily the same that are assigned to different sectors, okay? And also remember that sometimes you might have something work for a specific period of time, and then all of a sudden it's not working anymore. So always think, like we saw that in episode 3, we discussed it. You have to be very fast to adapt to a changing conditions, changing market. Okay, so it delivers an expected outcome in a high proportionate trade. Stress high proportionate trades because you will never get 100%. If you get 70%, 7 out of 10, it's amazing. Trust me, it's amazing. Okay, if you get 70 out of 10, it's great because then you have only 3 bad trades, and you'll be, smart enough to cut the loss on these, and then maximize the profits on the good ones. And then finally, you don't have to trade until you spot a setup. This is a very, very good benefit of waiting for a trading setup. Okay, you don't have to trade if you don't spot a setup. Don't, this urge that we all have. We just want to trade. We just want to see what's going to happen. We just want to see the money, the profits come in. Is sometimes not as good as it's not the best. So you don't have to trade until you spot a setup. And remember, trading is 80% waiting and only 20% execution. And finally, technical analysis combined with fundamental analysis. So usually if there is a trading setup, let's say a breakout or a breakdown, it's usually caused by a catalyst, right? That's fundamental. From a macro perspective, you have to look for this, you have to research this, and you have to be aware of this. So being aware of news, events, economical data on our economical calendar is very important, because these are usually the things that will cause a surge in volume, a breakout, breakdown. Okay, and so let's say we're trading the resistance, we're the reversal on the resistance. Once the price touches the resistance, we're trading the reversal. But if there is a very, very good economical data and people are just pushing the price up, sometimes the resistance won't mean anything. So we have to be aware of that in order not to take the risks and trade this resistance, unless there is maybe another confirmation that's telling us that no, sellers are going to stop at these levels and push price back down. Okay, so technical analysis combined with fundamental analysis, this will come with experience, with time, and you will be very good at it. But from now, you have to always be aware of it. Examples of simple setups. Let's look at a few examples. I put 4 here. There is many more. Don't complicate things. Like, I see people starting to see setups in everything. In the chart, they will start, and you read about them a lot. The handle, cup, the head and shoulders, the sky is the limit. I don't know what kind of patterns. They're all fine, but also simple setups makes it very simple. And if you start looking at every single setup in the world, then you'll be trading all the time, because for you, this is a setup. It looks like a cup handling something. I don't know what they call them. Okay, so yes, I'm going to use here. I'm going to show you 4 simple examples, very obvious examples, and then you can test and try some others. Remember, always look for setups that have high proportions of success. Higher proportion of success, the better. Reversal at support or resistance level, I just discussed that. Sorry. The strong area breakdown setups, or either a breakout or a breakdown. The opening gap trading setup, very interesting and challenging, unfortunately. And the trend reversal setup, okay? So this is a reversal at support or resistance level. This is an example of a reversal at very easy. We learned how to draw the resistance and support after 2 confirmed. Remember, someone asked me this last time, sending me a chart to my email and telling me, is this a resistance level? The resistance level, for it to work, or for it to be, a resistance level or support level, price has to drop back from it more than 2 times, not just touch it and consolidate on it. So in other words, this is the line of resistance. If the price goes up to the line of resistance and stays on it, yes, it's a resistance, but a real resistance has to be a resistance that triggers sellers to come. And sellers, what will they do? They will push the price back down. And so, like, for example, here, if you see the arrow, I'm not sure if the arrow shows when I share my screen. Anyways, I'm assuming that you see it. So this is the resistance here, and then the price drops. So, and then again, the bulls come back in, try to touch or cross that crack, that resistance, it doesn't work, and price is again, boom, right? Dropping back down and not just staying on it. So these are important things that you have to look for, and not just, okay, it touched this. And because remember, this is an imaginary line. This is a line that we're crossing. So it's not in cement, right? It could be 10, 20 pips higher, 10, 20 pips lower, depending on where you want to put it. I usually, as I said before, I usually put it on top of the candles and not here in the middle of the wick, like I did here, but it's fine, you know. It's usually an area, a zone, and not a line, not a price, and you don't put your stop 1 pip above it. It doesn't make any sense. So you put usually your stop loss somewhere reasonable, like here, the red line that you see here. And what's good about this setup, what is it? You're trading with your back against the wall. So you have a stop, very tight stop, but you have nice potential profits. Okay, so that's why I like this setup, because you're trading with your back against the wall. Another example of a reversal at support or resistance, you see this is the same chart. So let's say wherever you took your short entry, of course you don't short here because you're not sure if this is going to crack or not. So you wait for the next candle. This is an hourly time frame. So an hour later, look how patient you have to be. An hour later, the formation of the candle, it's done. Then you take your short entry anywhere here, and look what happened. This is the result. Okay, and of course we use a trailing stop to maximize profits because we don't know where this is going to go. At first, when I started, what I recommend when I coach is get out at the support level or where you think is a reasonable, reasonable exit point. However, with time, you have to maximize this because this is your only way if you want to make a lot of money. If you don't, yes, you will lock in profits. However, which is good, and it will boost your confidence. And that's why when I coach beginners, I always recommend get out at a reasonable profit. Okay, 2 to 1. Let's say you have 20 pips as a stop. You want to get out at least 40, 50, 60 pips profit because sometimes you're going to be stopped out, right? So you want the good trades to cancel out the bad trades and even make you more. However, with time, you will learn that, maximize it. Even sometimes I get out now 1 to 1 because I maximize, but then the price goes back up, trailing stop, gets triggered, and that's fine. Why? Because sometimes you make tremendous amounts. Then you can, one trade, remember guys, one trade sometimes in 1 month, even though you're doing maybe, let's say, 5 trades, 10 trades in a month, usually it's one that gives you the nice, good monthly paycheck or yearly paycheck. It's usually a few trades, big trades, and these are what we look for. And not every trade is like that. Okay, so it doesn't matter. You're just waiting for this, black swan that Nassim Taleb mentions in his book. Okay, trend reversal at moving average combined with near-term and medium to long-term moving average crossing. So this is an example of, this is the same thing, right? This is an example of a reversal at support or resistance level. However, like I said, this line that we draw here, the resistance or the support, is a horizontal line. But sometimes it doesn't have to be a horizontal line. It could be a moving average, right? Like in this case here, the moving average, there's a near-term and a long-term moving average. They are supporting our price, right? So sometimes it's the small moving average, the near-term. Sometimes it's this is, by the way, the 50 and the 100. And the 100 moving average. The 200 is somewhere around here, probably. Okay, I should have put it, but it's somewhere about around here. So that's the Euro USD. And then we see that this is the support. So the moving average is acting as support. And then what happens here? Of course, also we look at higher highs, higher lows. And then what happens here? Actually, look at this. This is, if you know what this candlestick is, what is it? Can anybody tell me? There's a few names for it, but I like this because this is usually a sign of a reversal signal. And I just noticed that, by the way, and I'm going to, let's talk about this for a second. This is a long tail up, okay? And this is usually a sign. What happened here is Okay, I'll put up a whiteboard if you guys don't mind. Let's test it. I've never tested this before. Whiteboard. Okay, everybody sees it? The whiteboard? Okay, so a long tail up. Thank you, Orlando. So a long tail up is, where's the pen? Here's the pen. So this is a candle, right? And this is another candle here. Of course, there is the wicks, the up, down, down. And then this is a candle as well, but it was a larger candle, but then it ended up the sellers just, you know, a wave of seller came at this moment in time and pushed price back lower, creating this long tail up. Okay, so this previously was a candle like that. However, before the time frame ends, boom, it disappeared and price is lower. And usually we need another red candle here for a confirmation. Okay, so this is usually a reversal signal in highly proportion of cases, and not all the time. This is not as well a magic formula, but it's usually okay, something happened here. The buyers might come back even stronger later on. It doesn't matter, because now we have a stop right above that, right? So let's say I took a short entry here, I can put a stop right on top of the long tail up, because 1 pip above it means it's gone. You know, the buyers won that battle in that particular time. Okay. And go back to our PowerPoint presentation. Okay, so what happened here? There is a reversal. Let's say this is, sometimes I use these reversal. Why? Because I'm trading a nice trend up, higher high, higher lows, and then I see this happens, and this is a very nice way to get out. It doesn't always work, but you know what? You can get back in if it does break it, right? You can get back in if it's canceled. Remember, when your entry point relies on something that happened, on a pattern that happened, on a trading setup, when this trading setup is no longer valid, your initial entry point is no longer valid, so you have to get out of the trade, right? This is an extremely important information. When you got into the trade because it's bouncing off the 20 moving average and this is acting as a support. Well, the price just dropped below the 20 moving average. What are you still doing in the trade? And 99% of people make that mistake. They're just in the trade. They're married to this position. You know, they don't want a divorce. Well, what are you still doing in? You just told me a couple of days ago that you went long because the 20 moving average is acting as a perfect support. Look at that. Well, it's not anymore. What are you still doing? Well, you know what? I put the 50 moving average, and now I think this is going to act as support. Wrong. Always, if the reason why you got in the first place is invalid, then your trade is going to is very, very high risk now to keep it. Okay, so this is usually an exit point for me. Okay, I usually use it as an exit point when I see the things followed by a red candle. Even though, look, the bulls tried to, later on go back higher, but they didn't cross that top. And then, boom, this is another confirmation of sellers. Just, this is a good price for us to sell. Get out of positions, or if you're long, or short if you want. And these are, obvious because they crossed the near-term moving average, and price went all the way to the long-term moving average, which is, again, the bulls are trying to provide support. However, here, final cross. And if you're already short here or you got out, you're very happy, right? You're not waiting on. Typically, this is where you should get out, because this is the real confirmation that there is a trend reversal. What is it? So many indicators. First of all, newer lower high, right? This is a lower high. This is a lower high, and finally, this is a lower high, etc. All right. And so, sorry, And so this doesn't necessarily mean that there is a trend reversal and we're going to go back down. Why? Because there's two outcomes. After an uptrend, what happens? There is a reversal, might be a reversal, and the trend goes down, or sideways market, which is extremely, bad if you only trade trending markets or swing trade. Okay, if you're a swing trader, you don't like sideways markets. So this might be now a sideways market, so you don't want that. Basically, what I'm trying to tell you is here, there is a cross. It is a trigger or a sell trigger, a signal. And yes, you have to sometimes say to yourself, this is going to be a trend reversal. However, if you see that the market's doing that, going back up above the moving average, back down, doing stuff like that, it's okay. You're not going to lose that much money on a sideways market, right? Because your stops will be above or below resistance support levels. However, you might, if it's actually a trending down market, you might benefit from it. Let's go back. Let's go to the next example. A strong area breakdown setup. This is what I call a breakout or a breakdown from a support or resistance. Okay, usually caused by a catalyst, an event, something happens for us to break out or break down. So usually these breakdowns are nicely stretched, and not just the breakout and comes back down. Because if it does break out and comes back down, it's a false breakout. And if the reason why you got in is because of a breakout and now the price is again below your resistance level, then there's no reason to stay in the trade, right? And these happen. Don't get frustrated. Just get out and say to yourself, because when you catch one of those, you're going to make tremendous amounts of money. So these small losses that you're going to take when they don't work, insignificant. Okay, don't even think about them as money. They're just part of the business. And so this is a structure break. Okay, look how we're supported here by this support. I called it all support because what happens is you don't wait for the structure break to most of the times to get into the trade. You wait for, well, this is the perfect case scenario. It went all the way back to test the support resistance. It failed, and this would be your short entry here. But most of the times, 90% of the times, it's not that perfect. Okay, it goes back up, but you will notice with time, volume is not there. You will see the volume. You will see that the volume is not there. The momentum is not there. The strength is not there, and you will notice with time and experience, and that this is actually failing to go back up. And trust me, you will know without it being that perfect case of a scenario. And again, what I do is I always enter my positions in three times. So second time when I get a better confirmation and confidence. The third time is when I'm sure my trade is going the right way. Okay. So this becomes the new resistance, and then the follow through breakout move, because it's a breakdown actually move. It's a breakdown. Okay. An example again of a strong area breakout breakdown setup. Again, it doesn't have to be a horizontal line. It could be a diagonal like this one here, the trend line we call it. That also you draw, or it could be a moving average, right? So sometimes instead of a horizontal line, the moving average or a trend line, like gold last week. Gold was going down, doing lower highs. But there was a horizontal support level that it wasn't crossing. However, from top, it was doing a lower highs. So I drew one of those trend lines, and then the break, and then it becomes a triangle, just like here. There's a triangle, right? And then the breakout or the breakdown will be either this way or this way. So what happens here is it was breakout towards the upside, and then back down again, perfect case scenario because it touched our support very nicely, and then boom, all the way. And this is a very again perfect case scenario. It doesn't have to be that perfect all the time, but just to show you how what a good setup is of a breakout. Okay, an example of a trend reversal pattern. We still have the opening gap, and that's it. So the trend reversal. What is the trend reversal? The pattern of a trend what is it? Higher highs, higher lows, higher highs, higher lows, etc. Right? So this is an uptrend. Okay, we went to this high and then consolidation, but it didn't go and do a lower high. This is the most recent up wave, boom, and this is the high that it did. And then here, the down wave is just as big as prior up wave. Ideally, we want it larger, right? We want a lower high. So we want it to go here because this was the lows, the lows of the consolidation, the previous consolidation. We want it to be lower, but in this case, it wasn't lower. It was still equal, but it still counts as, it's sellers are taking over or might be taking over. And then the next wave, we see that, it didn't even get close to the previous high. Okay, so wow, okay, so now there's a consolidation. We don't enter here. We wait for a pullback and we enter the short when price breaks below 1 cent below, 1 pip below. You see the consolidation here, perfect consolidation, 1 hour, 2 hours, 3 hours, 4 hours, 5 hours, 6 hours at the same support level, the consolidation, very tight, very narrow. What does this mean? This usually means there's struggle between buyers and sellers. Who's going to win? And you're just waiting for the outcome. Don't bet. Don't gamble. Don't say I'm with the sellers. They're gonna win. This is not a boxing match, and we're trying to see who's the biggest, toughest guy and bet on him. Or this is waiting for the outcome to tell, or for the outcome of the battle, and for the okay, we'll see that this guy just knocked down the other guy. Now I'm going to bet on the winner, okay? And you'll have higher chances of actually being right. So you wait, even if it's small, a couple of ticks, because the first confirmation of this pattern you got when you saw that it didn't do a new high, right? The second confirmation is when we went down and we touched the lower lows. So weakness. So 2 indicators telling us weakness. And then the third confirmation, just don't hesitate. Boom, take the trade. And then, this is a perfect also trend reversal pattern. The opening gap trading setup. Okay. What is the opening gap trading setup? First, let's look at this. Okay, this is the gap, the opening gap right here. When sometimes on the weekends or sometimes there is a headline overnight that happens that affects a certain currency, oil maybe, gold maybe, an index, NASDAQ, something happens overnight. Especially now, we're going to see a lot of these opening gaps in that, whether up or down. Why? Because the elections are coming in November. There's a lot of volatility in the market now, if you notice. And this is not even volatility because the VIX index is not even above 30 yet. Once it goes above 30 to where it was in March and April, 35 and 36, then there's even going to be much more volatility and much more gaps. So these gaps in the markets, we all know what a gap is, right? The market closes at a certain price. The next day or Monday, if it's a weekend, it opens up or down, and there is a gap. And there's something that a lot of people, I don't know where they get this information. Maybe you read about it a lot, but a lot of my students, they come and they say a gap means we're going to have to close the gap. There's a rule. Some I don't know who's spreading this rumor that a gap has to be closed. I don't think a gap necessarily has to be closed. And if someone did a study that shows that for the past 10 years, 80% of gaps are closed, then fine, I'm wrong. But I don't know any I wouldn't trade a closing gap. There's a strategy out there that trade the closing gap. What it means is whenever there's a gap, you wait for a to see if there is a sell, and then at consolidation you buy because this gap is going to be closed eventually in the future. What it means is you buy here and then you close when the gap is closed. You make money. I prefer to see the gap as a weakness. Most of the times that's what it is. Yes, sometimes something else happens and the price ends up closing the gap. However, in most cases, what is a gap? It means either weakness or strength. If the market opens higher, it's usually a sign of strength, not a sign of weakness. It's not necessarily going to close that gap. So anyways, this is the gap opening. This is just on a side note. I wanted to mention it. This is a gap open down. I'm looking for a short entry. Why? Because with this established weakness. So where is my short entry? It's usually somewhere where I see a pattern like this one. This is a this is a long tail up pattern. We just discussed it, right? So this is my short entry at this long tail up pattern, not necessarily when the gap closes. Sometimes the gap does close, but it doesn't matter. When I see a candlestick like this on an hourly time frame even, I'm usually very confident to get in. Why? Because I'm trading with my back against the wall. So my stop is extremely tight. I'm waiting for, a nice move back down because the gap opening down established weakness. The gap opening up establishes strength. And so the most conservative, this is a short entry. Most conservative is what I tell my students to do, is just get out when it goes back to the low of day. Because if there is a low during that day here, it usually, and then a bounce back up, it usually means that there's buyers around these levels, right? There's a lot of probably maybe limit orders around these levels. Market makers are seeing all these limit orders. Remember, they see the book, the flow. They see the client's trades. If there's a lot of trades at a certain level or a certain area, they see, and sometimes they scalp ahead of it to make the spreads, and so automatically they cause a bounce. So yes, this is the most conservative approach. Get out when it does the low. However, the most aggressive approach would be just to wait for the market to give us another signal. Usually, you put a trading stop at a moving average. Okay, so I'll put a trading stop around the moving average, and this would be my the trigger that causes my stop to get triggered. Or lower low, you're not a lot of people like to watch the charts all the time, and maybe you don't have time, maybe you have another job. So put a trailing stop. Or if you have time, then you watch the chart and you see when if there is actually a trend, because you want to benefit most, right? You want to maximize the profit. So if there is a trend and a lower low, lower high, lower low, lower high, lower low, lower high, then you're maximizing your profits. Okay, final slide is the exit approach. Exit approach, again, the exit strategy is extremely important. Remember what I just told you, 90% of people don't even think of their exit. Exit is the most important in my opinion. Everybody can enter a trade. Yeah, there is a reversal signal here. Okay, boom, I'm in the trade. Okay, when are you gonna get out? I don't know, we'll see. No, there's no such thing as we'll see. If you entered the trade for a reason, and the reason is no longer valid, again, what are you still doing in the trade, right? So the passive exit approach, a lot of people just enter a trade and say, okay, I'll exit when my initial stop loss is hit. So I'm trading and I have a stop loss. Okay, obviously, otherwise you're doing something wrong, or you're so confident that you're not going to lose money, but eventually we know what this happens. If you the Jesse Livermore story we discussed in the previous webinar. So exit when your initial stop loss is hit. This is a passive exit approach. Or exit when your target price is hit, right? So you have to take profit. This is my exit. Fine. But a more active approach, smarter approach, experienced trader approach, successful trader's approach would be to exit when your trailing stop is hit, because you're maximizing profit. You exit when the reasons for taking this setup are no longer valid. You're short because the moving average is acting as a resistance. With price just crossed it, what are you still doing in your short, right? And remember, when I say price cross, it doesn't mean price cross just above the resistance. Resistance levels are not magic formulas. So price might cross up or down from them many times. If you're looking at a 4-hour time frame, you have to be patient for 4 hours, because you want the 4 hours candle formation to be above the moving average. That's why I look at the hourly time frame when I exit. Why? Because if you're looking at the 4 hours, a lot of things can happen in 4 hours. So your stop is extremely, not tight in 4 hours, right? So hourly time frame is much better to exit, because then your stop is not that bad, and you're not going to, either if you're maximizing your profits, you're not going to, it's not going to eat up most of it, or if you're just getting out because it's a stop loss, then your loss is not going to be that high. That's it, I think. Okay, that's an example here of an exit strategy. Okay, so this is the level of resistance that we drew. Okay, it's here. Look how here there is obviously a fault. The resistance could be here, but however, the resistance was established, the level of resistance was established. Why? Because one, price dropped back for 4 or 5 hours, then it surged back up, tested it, tried to test it again here, trying to pull back. This is, yes, a full candlestick here, but there is usually, again, it could be a couple of pips higher, a couple of pips lower, and then the price goes back down. However, this is a sideways market. So why is it sideways market? Look how the moving average is not acting as much. It's not doing much. But then all of a sudden here, we break that resistance line. And this is a nice confirmation. Why? Because we try to go back down, but we don't even get close to the resistance line. And then price starts surging again. So this is our entry. And where's the stop? The trailing stop, placed at the MA. So the trading stop is placed at the MA. And then this is your stop right here when there's a full candle. You see how it's usually when there is a full candle, it means, unfortunately, it could be large, just like this one. So you exit. You probably exited here, right? So you missed this. You still made money, but you missed this. But there was no signal here. There was no long tail up. There was no engulfing candle. There was no one will ever guess that this is the top. And never, always people get frustrated when they don't get out at the top. And I've seen this so many times. And this frustration leads to more frustration and eventually to losing your temper, losing your discipline, losing your edge, and losing money. Okay, so don't try to time it perfectly. I've never seen anyone always get out at the top and get. Who is that genius who has exactly what it takes to get out always at the top? You're never going to be able to. If you get out here, let's say you got out here, who knows? The price might go up higher. You'll be frustrated. Oh, I got out too early. Okay, so here there's actually a reason to get out. We just crossed the moving average. You're not frustrated. You didn't make the most out of the trade, but it doesn't matter. You're still in the money. You still made money. This is what's important. Okay, consistency. So it's not whether you're right or wrong that's important. It's how much money you make when you're right and how much you lose when you're wrong. George Soros. That's it for my presentation. Ron. Any questions, first of all? Sorry, guys. Sinjan, yes, okay, I'll send you the presentation. Of course, I'll send you the PowerPoint, and whenever you want, also we can have whenever I have time. I'm going to have more time maybe next week, so we can have a one-on-one present. Whenever you fund your account and start trading, don't hesitate. Ring me, send me an email, a message. Tell me when you have time for a quick 10 minutes. We can log in one-on-one. I don't mind at all. If I don't have time, we'll set up an appointment and we'll do it at a later date. Okay. So we do that for our clients. It's not a favor. Okay. We do that for all clients. So by all means, don't hesitate. Go ahead, Ron. How are you?
Okay. Thank you for the presentation, Rony. I'm sure everyone benefited a lot from that. One thing that I really liked that you mentioned was the story you told at the beginning of your presentation about the one trader you had who literally had support and resistance lines all over the chart, and you could barely see the price action. I feel like it was very important for a lot of traders who are just starting out, who might get sucked into the whole idea of having all these different indicators and support and resistance lines all over their charts. Like Rony said, simplicity is the key. So with that said, I wanted to talk a little bit more about what we've been working on in the background. Some of you might know about it. Some of you might already be part of it. But that is the virtual trading floor. And let me just share my screen so that we're on the same page here. Right. Okay, so this page basically describes everything that the virtual trading floor is. So the whole idea behind the virtual trading floor is that we build a community, because at the end of the day, when we trade as a community, we're more powerful in the numbers that we have, and we can actually help each other out in areas where others might be struggling. So this virtual trading floor is really for you if you're the type of person who wants access to our trades, if you want access to everything that Rony and his team are working on in terms of analysis, you have access to that within the virtual trading floor. And it's really for you as well if you're looking to improve your trading through coaching from real professionals. And that's one thing that I feel like is really short within the education space within trading, because a lot of the educators you find on social media and all that are people who have been trading the markets for 1 or 2 years. Some of them may or may not know what they're doing, but what you really get within the virtual trading floor is you get true professionals who have actually been in the industry for a number of years. Like Rony said, when you join the virtual trading floor, when you fund your account with Squared Financial, you can actually have a one-on-one with Rony, and they don't charge for that or anything. So you get trained by true professionals. I mean, Rony's been doing this 20 years. I've been doing this 5 years. The other trader from Pine Street Capital, Taps, he's been doing this 5 years. So we've actually got experience within the field, and we can help you out. The other thing is, it is for you if you want to shorten the learning curve. The thing with trading is to really make this work for yourself. You can either go through all the pain that we went through. I mean, I myself went through the trading journey, and it took me about 2 years to reach profitability. But if I had a resource just like this, I probably would have reached profitability a lot sooner than I actually did. The other thing is you also learn to master all the skills that you need to trade profitably, right? And that's essentially what you get within these webinars. But then with the one-on-one work that you get to do with myself and Rony, you really get to take that to a whole new level. And it can really help you to the point whereby you can actually scale up to the point whereby you are a full-time profitable trader. We have resources within the virtual trading floor that are going to help you level up and continue leveling up until you reach the point where you want to be as a trader. And another crucial thing, which I mentioned before, was the fact that you get to connect with a lot of people within the community. A lot of the traders within our community are based in Cape Town. So you actually get to connect with traders within the same city as you. Most of the attendees here are based in Cape Town. So you really get a chance to connect with us, and we come together as a community. Like I said, there's a lot of power in what we have. So what's actually there behind the scenes within the virtual trading floor? So within the virtual trading floor, you obviously get our trade signals, right? And with our trade signals, they are different from the kind of signals that you receive anywhere else, because of the fact that rather than just giving you the entry points, the exit points, we also provide you for the reasons why we took those trades. And because you've got the reasons why we took the trades, you actually learn from the signals that we provide, rather than just blindly copying a buy or sell signal and not knowing why you took it, right? The second thing you get, which I mentioned, was the one-on-one coaching. And this is crucial because with one-on-one coaching, you can actually go in and tackle the areas within trading that you need to work on specifically. So that's with one-on-one coaching. then you get access to the virtual trading desk. Now, this is probably the coolest feature of the virtual trading floor because of the fact that you actually get 24/7 access to all our traders within a voice and a chat channel. So you could literally come in intraday and you're thinking of maybe taking a Euro USD long, right? And you want a second opinion about that trade from our trading desk. You could literally come into the voice channel and say, hey guys, I'm trading Euro USD. What do you guys think about it? And in real time, we can actually tell you what we think about it there and then. It will be as if we're actually on a real trading floor. So that's with the virtual trading desk. The other thing that you get access to is institutional level trading conditions. So Squared Financial has been around for 15 years, right? And I know with a lot of the people who came in here, they came in without really knowing who Squared Financial is and what they're about. But basically, background information, Squared Financial is a broker that's been around for the last 15 years. The reason you've probably never heard of them is because they've been catering to institutional clients since inception. But then as of recent times, they've started to offer their services to retail traders such as us. So now rather than trading with the regular retail trading conditions that we're used to, now with Squared Financial, you can actually get access to the same trading conditions that hedge funds and institutions get access to. And with the value-added services that you get in terms of the guidance that you get from the Squared Financial team, along with us, it just takes it to a whole new level. So that's essentially the virtual trading floor. As for what you actually get when you get inside the virtual trading floor, you get access to the Inner Circle members area. And the Inner Circle members area essentially gives you access to all these resources. You have the past webinars, you have the course, you have the Telegram channel, and the most important thing is the virtual trading floor. So let me show you what the virtual trading floor actually looks like. Right, so this is the virtual trading floor. There are about 6 main channels. I'll just explain some of them briefly. Introduce yourself channel. You just tell us about yourself and your trading, where you are. Then you've got the trading discussion channel, where you can basically share anything that's on your mind, trading related, of course. Then we've got the questions and answers channel, which I essentially reserved for questions related to the Forex Trading Masterclass course, which we give you access to when you get into the virtual trading floor. Then you have access to the trading desk channels. So the trading desk chat is essentially our everyday chat, whereby we talk about what's going on in the markets. We talk about trade ideas. You know, you're going to see a whole bunch of charts within the trading desk channel. Then you get the trading desk signals, which are essentially the trade setups that we are taking on that particular day. Here's the NASDAQ trade that I shared earlier on. You also get analysis from Rony as well. He records a couple of videos about what's going on in the markets. I know he also does the week ahead session every week, so that you know what's coming up in the markets in the coming week. Then finally, the virtual trading desk voice channel, so you can literally jump in at any time and ask your questions. Now, if you want access to the virtual trading desk, all you need to do is fund your Squared Financial account with at least $100, and you have complete access to the virtual trading floor. On a normal day, we charge $97 per month for that membership. But then because of the fact that we're partnered with Squared Financial on this particular project, you get access to it completely for free. Now, one thing you'd need to ask yourself is this really worth it for me, you know? And my question for you is, if the virtual trading floor was able to provide you with at least one more profitable trade over the next week, over the next month, would it be worth it for you? If the virtual trading floor was able to provide you with the skills that you need to get from the point of being a break-even trader to being a profitable trader, would it be worth it? All up to you. But that's all I have to say about the virtual trading floor. Thank you very much for attending the webinar. I'd really love some feedback on this. You can send me a message on WhatsApp. You can send Omar a message on WhatsApp. The feedback is really what keeps us going and helps us to sort of optimize these sessions for you at the end of the day. So with that said, thank you very much, everyone. I will catch you next week.
Thank you, everyone. Bye-bye.